Welcome to the Lion's Share podcast, where we break down today's most impactful research and bring fresh insights from the academic frontier straight to you.
You know the rule in corporate finance, right? A manager's job seems simple. If a project has a positive net present value, you take it, period. It adds value, so you invest. But the real world, and specifically the capital market, often makes this, well, impossible. If that great project requires issuing new equity, suddenly, otherwise valuable opportunities get shelved. Why would rational, value-maximizing managers willingly pass up easy money? That paradox is the focus of our deep dive today. We are ripping apart one of those cited and, frankly, fundamental papers in finance history, Myers and MAJLUF's 1984 masterpiece. For you, the learner, this isn't just theory. This is the intellectual blueprint for why capital structure matters. Our mission is to extract the deepest insights, understand the precise mechanism of this financing trap, and ensure you walk away with critical context for your own work. Okay, let's get into it.
Yes, we can start right at the core objective, which is refreshingly straightforward in the abstract. They're modeling a very specific company. It's one that has a valuable investment opportunity, but, and this is the key, it has to issue common stock to finance it. The entire model really hinges on one piece of friction.
And it is.
Management knows more. They have superior private information about the firm's true value, its existing assets, the project's real NPV, compared to what outside investors can see.
That's the catalyst then, the information asymmetry. But what does that actually lead to? Because the outcome is what makes this paper so famous.
Precisely. The outcome is the equilibrium where the market is being completely rational. Since investors know management has better info, they interpret the decision to issue stock as an adverse signal.
As bad news.
As bad news, yeah.
Oh, yeah.
It suggests the stock is currently overvalued, or at least not severely undervalued. And this negative reaction, this price drop, can be so steep that it forces rational management to say, nope, not worth it, and pass up a good project.
Which is a huge misallocation of capital in the economy.
A massive one.
You know, this is where it gets really interesting, especially for anyone grounded in classical finance. Myers and MAJLUF were basically challenging the Modigliani-Miller theorem, that idea that financing and investment decisions are separate things.
Exactly. They wanted to build a model where differential information forces these two decisions to be tangled together. That was the central academic contribution.
So it showed that even in a perfect market, just having private information makes financial choices matter for real economic outcomes.
Yes, and practically speaking, this was the first rational explanation for behavior we'd already been seeing for years, right? We all knew firms hated issuing new equity.
Right.
This model gave us the math for it. It explained why companies lean so heavily on internal funds cash flow, retained earnings, and why they prefer debt over equity if they have to go outside. It's not just a habit, it's a rational defense.
So the theoretical framework has to be rock solid to make that case. We have asymmetric information as the foundation.
And it's operating within an otherwise perfect capital market. No taxes, no transaction costs. They're isolating the one variable that matters.
And how do they structure that?
They use a really elegant three-date model. Think of it like a timeline. At time t=-1, everyone had the same public information. Everything's symmetric.
Okay.
Then at time t=0, boom. Management gets a private update. They learn the real value of the assets, the project, but the market doesn't.
So the information gap opens up.
That's the window of asymmetry. Then later, at t=+1, the information becomes public again, maybe through an earnings report, and the gap closes.
But the real genius here, and maybe the most controversial part, is the assumption about who management is actually working for.
Yes, this is crucial. For the model to work, the authors had to assume that management acts strictly in the interests of the old or existing shareholders.
Someone who are already there.
Exactly. They are trying to maximize the intrinsic value of that existing stake, not the total market value of the firm after the new stock is issued.
Wait, hold on. If the project is positive NPV, wouldn't maximizing the total firm value also maximize the value for everyone? Why does focusing only on the old shareholders create this conflict?
It creates a conflict because of the pricing. I mean, imagine management knows the stock is trading at $50, but they know privately it's really worth $100.
Okay, so it's deeply undervalued.
Right. If they sell new equity at $50 to finance the project, they're basically taking $50 of value from the old shareholders and just giving it away to the new investors.
A massive dilution.
A huge dilution loss, and that can easily wipe out the entire benefit of the project. If their job was to maximize value for everybody, old and new, They'd just issue the stock and take the project, no problem. But because their loyalty is only to the existing owners, financing choices suddenly dictate real investment.
That single assumption is the engine that powers the entire dilemma. It also leads us right to the concept of financial slack.
Correct. Slack is just introduced as this known fixed resource. It's cash, securities, or unused risk-free debt. It's the safety cushion.
It's how the firm can bypass this whole problem.
Which is why it becomes so valuable.
Okay, so let's talk about the methodology. The context is beautiful in its simplicity, really. You have this idealized firm with one asset, A, and one investment opportunity, B, that requires an investment, I.
And that investment opportunity has a ticking clock. It has to be taken at t = 0 or it's gone forever.
Yeah.
The sample here isn't a list of companies. It's the theoretical probability distribution of the firm's true asset value and the project's true NPV. So this is a purely deductive analytical study. It's all equilibrium modeling.
So it's a theoretical framework operating at the firm level, and they're using that three-date design to find this self-fulfilling rational equilibrium. The market expects the firm's strategy, and the firm expects the market's reaction.
It's a perfect loop of incentives. And that brings us to the mechanism, the core relationship that actually generates the trap. Management's decision rule is a trade-off. They'll only issue stock and invest if the benefit from the investment outweighs the value that they're transferring to new shareholders through underpriced equity.
Let's break that down intuitively, because this is kind of the aha moment. It's a fight between a gain and a loss.
Exactly. The gain is the project's NPV, B. The loss is the dilution. If management knows the stock is severely underpriced, meaning their existing assets, A, are actually very, very high.
They'd be giving away a huge chunk of value to the new guys.
A huge chunk. So if the firm is a diamond mine, management would rather skip a pretty good project than sell off a piece of that mine for the price of coal.
That is the perfect analogy.
And paradoxically, that means the firms most willing to issue stock are the ones who know their existing assets aren't that great. Their stock isn't as undervalued.
And that willingness to issue, that's the signal.
As a signal.
This signaling mechanism leads us right to the 4 critical findings that everyone needs to internalize. First, and this is the big one, underinvestment. Firms rationally pass up good projects, positive NPV projects, if they need external equity. This is a massive misallocation of real capital in the economy. The NPV rule is violated just because of an information gap.
Second, the value of slack. It's quantified and celebrated here. Financial slack, that cash cushion, significantly reduces this loss in firm value and makes it way more likely the firm will invest.
And if they have enough slack to fund the project internally.
Then the problem just disappears. The loss is 0. All good projects get taken. Slack basically insulates the firm from this whole trap.
Okay, third, the empirical fallout, the stock price reaction. The model predicts that the decision to issue stock always reduces the stock price, on average.
Always. Because the market reads that signal and knows that if the firm were a real diamond mine, management would have let the project die rather than dilute the existing owners.
So the market rationally interprets the issue as bad, or at least less good news.
It's a self-fulfilling prophecy, and it's why we see those negative returns when companies announce they're issuing new stock. This model explains it perfectly.
And finally, the fourth finding. This is the theoretical justification for the financing hierarchy, what we now call the pecking order theory.
Yeah, the analysis predicts firms will prefer safe securities over risky ones. The rule they state is, essentially, better to issue safe securities than risky ones.
Why is that?
Because issuing risk-free debt is like having slack. Its value isn't as sensitive to management's private information, so it doesn't trigger the same adverse selection problem. This gives you that hierarchy. Internal funds first, then safe debt, then risky debt, and equity is the absolute last resort.
Let's pull out some of the most impactful quotes from the paper then, the statements that really carry the weight of the theory.
Okay. On the core signaling message, I'd use this one. The news conveyed by an issue is bad, or at least less good. It's concise, it's perfect.
And on the solution, that preference for different capital sources.
I'd go with the general rule seems to be better to issue safe securities than risky ones.
Simple enough.
And finally, on the valuation consequence, this is the one. In our model, the decision to issue stock always reduces stock price unless the issue is a foregone conclusion. That one really captures the empirical power of it all.
So we've broken down the paper, but let's zoom out.
Mm-hmm.
What does this all mean? Why are these findings so important?
Well, this paper is foundational because it gives us a reason, based purely on information, for why capital structure matters. It's a profound contradiction to the old Modigliani-Miller world.
Right.
It shows that when a firm hoards cash or avoids equity, it's not sloppy management. It's actually the rational wealth-maximizing strategy for their existing shareholders.
And for its use, scholars still rely on this model as the bedrock for the pecking order theory. It continues to guide decades of empirical research on stock price reactions to security issues.
And for practitioners. Oh, it's direct. Managers use these concepts to justify keeping high cash balances, what they call financial flexibility. That slack protects the firm from ever having to face the financing trap. It guarantees they can capture growth opportunities without getting hammered by dilution.
So the 5 essential single-word tags here would be 1, asymmetry, 2, financing, 3, investment, 4, slack, and 5, equity.
The whole dilemma really comes from that asymmetry creating a rational reason to underinvest. But while the paper presents financial slack as the hero, the ideal solution, we should leave you with a final thought for your own research.
Okay, let's hear it.
Late in the paper, the authors mentioned that if old shareholders were active, meaning they were constantly rebalancing their portfolios based on what management was doing, financing might become irrelevant again. So that raises a question. Is the real long-term key to solving this problem some other kind of commitment mechanism or better communication rather than just hoarding cash? If a firm had zero slack, what else could managers do to credibly signal their firm's high value and make sure good investments happen?
A worthy challenge indeed, and a perfect jumping-off point for future research. Apply the rigor of this structural review to your next stack of sources.
Thanks for tuning into the Lion's Share podcast. If you enjoyed today's discussion, share it with a friend and join us next time for more ideas worth talking about. We'll see you next time.